So give us your sense of maybe what went wrong. Why didn't we see this coming? What happened with Silicon Valley Bank and then Signature?
Well, thank you for having me, first of all, David. I think we can point to a few things, and we'll know more after the Fed completes its review of what happened with supervision during this time. But it appears to be that the regulators, at least, are saying, based on what's come out so far, that they did give some warnings. The management doesn't seem to have acted on those. At the same time, the rating agencies didn't see this coming, but neither did most Wall Street analysts. And while we can do all those sorts of postmortems, at the end of the day, this really was about bad bank management from my standpoint. I mean, this is a management that didn't have a credit risk officer, chief risk officer, and really overestimated the stickiness of its deposits. I think that was one of the main things. So I think really as we do all these postmortems, the question really should be focused on why didn't management do more to prevent this sort of thing from happening?
Hindsight's always 2020, in my experience at
Right.
least. It's easy in retrospect. But looking back at it now, and it's the ratings agencies, it's the regulators, it's even the stocks analysts. If you look at what they had a price on the stock of
Exactly.
like $231 just before it went to zero. And yet the risk was interest rate risk. It was not a secret that the Fed was raising rates and raising them rather substantially, rather quickly.
Right. I think that's right. And obviously, a lot of banks had that. But that's where I think we really do have to recognize that what was particular about Silicon Valley was its deposit profile. Its deposits were concentrated in the venture industry. That is an industry where I think you've got to expect the deposits will not be sticky. And so, we've talked a lot about when interest rates rise, people should have realized that on the asset side of the balance sheet, they were now exposed to losses. Yes, that's true. But it's also the effect of interest rate rises on the deposit side. Those deposits are going to become even more hot in a way as people look for higher yields. And the firms that were using SVB obviously were facing more challenging operating environments, needed more money. So you had conditions building up that could easily lead to a flight of deposits. And I think this is a management that just appears to have always overestimated the stickiness of those deposits. And in an age of social media, we almost have to redefine stickiness entirely because, how quickly this run happened was really striking. I mean, to have 40 billion in deposits basically leave in a day was pretty incredible.
And that raises the question, Tim, that's been raised by others actually. How much of this is technology that basically our systems, whether it's ratings agencies or regulators or whatever, haven't kept up with the technology because people could withdraw their deposits just with their smartphone instead of having to line up at the bank? And does that raise real issues, for example, for the ratings agencies, that they cannot keep up with the speed of light?
No, they can't. And again, I'm sure, if you're in a rating agency, you also don't want to cause the bank run. The real question, I think, is how do we have a system where a bank can fail without it triggering a systemic problem? And that may really require us to kind of rethink the banking model. Do we need different types of banks for different purposes? Narrow banks that do more limited functions and where we could maybe have guarantees of all the deposits versus banks that, are more engaged in creating credit and are subject to different sorts and tougher requirements. I think we may have to start thinking a little bit more broadly about how we're defining banking. And, in order to really get to a system where you can have risk and have failure without it requiring, government bailouts or posing a systemic risk.
Tim, eventually, of course, the government did step in and guarantee all those deposits without limit. Take us back to 2008, 2009. Is the current system, the way it's structured, does it require the Fed and the agencies basically to allow a bank to fail before it has the statutory authority to step in?
Yeah, that's absolutely right, David. In 2008, the FDIC did come up with a way to guarantee all bank deposits when the crisis really started to escalate after Lehman failed. They guaranteed all deposits, and they also put in place a guarantee of new bank indebtedness. Now, they used what was called the systemic risk exception to do that, but traditionally, the systemic risk exception was only used in the case of a failed bank. And in the case of a failed bank, you could make certain changes, including guaranteeing all the deposits if that was going to minimize the cost to the FDIC. After 2008, when we implemented Dodd-Frank, the FDIC's ability to guarantee all deposits of solvent banks was taken away. You can only do that with the approval of Congress. So they were just left with the traditional interpretation of the systemic risk exception, which is if a bank fails, then they can, when they step in and seize it, then they can do certain things to minimize costs, including guaranteeing deposits. That is what they did for SVB. But when people say, well, this means all deposits are guaranteed, well, actually right now it doesn't mean that because they don't have that power.
Did that increase the risk to the system in your judgment, Tim, having been there at the time in 2008, 2009? Does it increase the risk to say you have to go actually over the edge of the waterfall before you can really rescue them?
Sure. I mean, look, I think coming out of 2008 and Dodd-Frank, we did a lot of things to strengthen the system. We increased bank capital, we put in other prudential safeguards, and that was all very good. But we also limited some of the tools that we have to deal with a crisis, and we didn't have great tools to begin with. Now, it is true in Dodd-Frank, we added a tool or two, such as the Orderly Liquidation Authority, which allows the FDIC to seize a non-bank. But I think, you know, when you look at the U.S. relative to, say, Japan or Europe, our crisis-fighting tools are more limited. Now, that's because of very legitimate concerns about moral hazard. You know, we don't like government stepping in and guaranteeing, you know, a failed bank or something like that. But nevertheless, you want to prevent a systemic crisis. So, you know, balancing those two things is a hard thing. We may have erred, however, on the side of taking away too many tools, forcing, you know, regulators would have to go to Congress, and you never know whether Congress will act quickly enough. But again, it comes back to how do we design a system where, you know, the government doesn't have to step in just because you have bad management at one bank. Or you have to step in, but you don't have to, you know, do something systemic.
Tim, from your experience, where do you come out of the moral hazard question? I mean, in this instance, the government came in and guaranteed all the deposits, although, as I understand it, the shareholders and the bondholders got wiped out. Is that enough to take care of the moral hazard? I mean, there's enough of a penalty that the next bank management is not going to try to do that again.
Yeah, exactly. I mean, look, there's always going to be moral hazard in these situations. You're faced with a set of bad choices when something like this happens. And you know, you end up having to pick the least bad of those choices. And when you do what the FDIC did, you know, there's obviously going to be some moral hazard consequences of that you don't like. But the alternative was far worse. I do think the fact that, you know, management was kicked out, bondholders were wiped out was good. One of the things is, though, that, you know, the holding company was still there. I do have some questions about why that was, you know, should something more have been done there.